Welcome to the deep dive. So if you've been watching the market headlines this year, 2025, I mean, you've probably seen a lot about new records, right?
Oh, yeah, absolutely.
The S&P 500, it's up, what, a solid 12%? And the NASDAQ composite even better, something like 15%. It really feels like, a rising tide lifting all boats.
It does feel that way on the surface, but when you actually zoom in a bit past those big index numbers, you start to see the story as, well, a lot more fragmented.
Fragmented how?
Well, while you've got a handful of these mega cap stocks driving the indices way up, there's this whole other group of companies, really interesting businesses actually, but their stock prices, they're still trading at these deep discounts. We're talking 50%, sometimes even more, off their old peaks.
Right, and that's the fascinating split, the dichotomy we want to get into today. It makes you wonder, doesn't it? For investors looking around, the question isn't just what's going up now, but maybe what's coiled, ready to rise next. Are these stocks down so much because they're fundamentally broken? Or is there a turnaround happening that the market hasn't fully bought into yet?
Exactly. That's our mission for this deep dive. Look past the big market moves and really analyze two specific companies that are showing pretty major successful operational rebounds, but they're still heavily beaten down because of past events.
Okay, so who are you looking at?
We've picked two very different kinds of turnaround stories. First up is Carnival Corporation, the cruise line, ticker CCL. They're dealing with the aftermath, the sort of residual scars of a huge external shock to the pandemic, obviously.
Yeah, an external shock recovery. And the second?
Second is Unity Software, ticker U. Their story is different. They had to pull off a really painful internal strategic correction, basically fixing management mistakes.
Got it. So we're looking at the unique risks, but also the opportunities that pop up when a company's fixing itself, but the stock price, well, it hasn't quite caught up yet.
Precisely.
All right, let's unpack Carnival first then. CCL, I mean, you look at the chart, and the discount itself is kind of the mystery, isn't it? Despite all the positive news, the momentum everyone sees, the stock is still, what, 57% off its all-time high?
Yeah, 57%,
Yeah.
substantial.
But then, and here's the counterpoint, it's up almost 100% over just the past year. So how do we square that, this massive recent jump with still being so far from the peak?
Well, that gap, that tension you just described, that's basically where the market opportunity lies, or at least where investors are betting it lies. Because
Okay.
if you look purely at the business, the fundamentals, the momentum isn't just recovering, it seems to be accelerating, even past where they were before.
Right.
I mean, Carnival's the biggest cruise company globally, and they are reporting record growth, really phenomenal customer demand right now.
And those Q2 numbers they just reported for the quarter ending in May, they really seem like a masterclass in operational efficiency.
Absolutely.
Record revenue, record operating income. And they didn't just meet their guidance, they beat it across the board. Adjusted EBITDA, adjusted net income.
Yeah, and what's really interesting is how they quantify that efficiency. They specifically beat their guidance on net yields.
Okay, maybe unpack net yields quickly for listeners.
Sure, it's basically the revenue they generate per available cabin per day. So when you hit a record on that metric, it tells you something important. It means they're not just sailing with full ships. Lots of companies can do that by discounting. It means they're filling them at really efficient, high-ticket prices. They have pricing power.
Ah, okay. That makes sense. And the customer confidence side looks strong, too. I saw something about deposits.
Staggering is the word I'd use. Their key metric for future demand customer deposits hit an all-time high, $8.5 billion.
Wow. $8.5 billion.
Just think about the visibility that gives them. They already know that 93% of their entire 2025 capacity, their occupancy, is already booked up.
And booked at good prices, you're saying?
Exactly. Booked at those robust ticket prices we just talked about. That gives the company huge stability for planning and forecasting. It de-risks the near term considerably.
And strategically, they seem to be hitting their marks, too. Something about a CA change strategy.
Yeah, that was a big one. It's their core management initiative focused on sustainability, adjusted EBITDA targets, and return on invested capital CA. They set these multi-year goals,
Yeah.
and they hit them a year and a half early, ahead of schedule. Now, when a massive company like Carnival, with all that capacity, executes its core strategy that quickly, That's a huge confidence signal.
Right. It shows management is really on the ball.
And it directly led to them raising their full-year guidance across the board. Higher
Yeah.
revenue expectations, higher profit expectations.
It sounds like they're not just coasting on the post-pandemic travel boom either. They're actually investing back into the business
Yeah.
to keep this growth going long term.
Exactly right. You can't just assume the demand stays forever. They're actively improving the product.
Like what? New ships?
New ships, yes, but maybe even more importantly, destination exclusivity. They just launched Celebration Key, which is this new private destination they own in the Bahamas, and they're expanding other exclusive spots too.
Why is that so important, the private destination thing?
Because those are high-margin experiences, they control everything, capture more spending, and it boosts customer satisfaction, makes people want to come back. It builds loyalty.
Got it. And the new ships. I saw something about a Carnival festival.
Yeah, that's coming in 2027. It's going to have features like Sensation Point, apparently this big outdoor family zone with a water park.
So these aren't just like minor touch-ups.
No. These are major capital investments. They're designed to make the whole cruise experience stickier, drive those repeat bookings, and justify the higher ticket prices.
Okay. So the operational side looks, well, phenomenal, frankly. Record demand, hitting targets early, investing smartly. But we have to talk about the elephant in the room, right? The thing that's keeping that stock price 57% off its peak, despite everything you just said.
The debt has to be the debt.
Let's get specific. I saw a number. Wait, $27 billion, is that right?
That's the figure. End of Q2 2025. Over $27 billion in debt on the books.
How does that compare to before the pandemic?
Significantly higher. Massively higher, actually.
So if the operations are so strong, why hasn't the market just looked past the debt and priced in the recovery already? Is it really just the debt holding it back?
I think it absolutely is the main anchor. And it's not just the sheer amount, the $27 billion, it's the kind of debt it is.
What do you mean?
A lot of this was taken on during the pandemic shutdown. It was basically emergency funding, often at high interest rates, just to survive when zero revenue was coming in.
So it's expensive debt. Toxic, almost.
You could call it that. And paying the interest on that mountain of debt, well, it severely eats into the huge amounts of cash their operations are generating now. All that record revenue gets partly offset by massive interest payments.
I see. So that legacy debt burden is just crushing investor confidence, and that's why the valuation is where it is. What did you say, less than 14 times forward earnings?
Yeah, less than 14 times forward 1-year earnings. That kind of multiple screams caution from investors.
Right, but that caution is exactly what creates the potential opportunity, isn't it? For longer-term investors who believe Carnival can actually manage this balance sheet problem.
And they are actively managing it. It's not like they're ignoring it. They've refinanced $7 billion just this year.
Doing what exactly? Pushing out the dates?
Pushing out maturities, yes, and hopefully locking in lower interest rates where possible, although that depends on the market. They also prepaid $350 million of the $1.4 billion that's due next year. So there's a clear debt reduction strategy happening.
Okay, that's good. Proactive steps.
What's really interesting, though, is how much their success in tackling this debt depends on things outside their control. Macro factors.
Like interest rates.
Exactly. If interest rates continue to fall, that provides a huge tailwind for them. It makes refinancing much cheaper, frees up more cash flow, and lets them pay down the actual principal faster. Their fate is tied to the Fed to some extent.
Okay, so the key takeaway for Carnival seems to be incredible operational rebound, fantastic customer, demand, a really strong business story. But it's all being overshadowed by this heavy lingering debt from the pandemic era. The opportunity, the discount, it exists because of that debt risk, not despite it.
Perfectly put. And that sets up a really interesting contrast with our second company, Unity Software, because Unity presents a very, very different kind of turnaround narrative. Their problems were largely self-inflicted.
Right. And Unity's discount, as you mentioned, is even deeper. That tells you something about how severe those internal missteps were. The stock is, what, 77% off its all-time high from back in November 2021?
A staggering 77%. Yeah.
But similar to Carnival, it's showing signs of life. A strong recovery, actually. The share price has more than doubled over the last year. That seems like a big signal that whatever corporate surgery they did, well, maybe it worked.
I think that's fair to say. Unity's core business, remember, is really strong. They make the software tools, the game engine services that a huge chunk of video game developers rely on. Plus, they offer digital marketing tools. Technologically, they're still in a very powerful position.
So where did it go wrong?
Well, like you said, the problems were internal. They made some really aggressive, maybe overly aggressive growth bets that didn't pan out. And crucially, they rolled out some flawed monetization strategies.
Ah, yes, I remember that. That caused quite a bit of drama, didn't it? A real backlash from their core users, the developers.
It really did. It damaged trust significantly. And that's what necessitated this major pivot, this turnaround effort, which really kicked off when the new CEO, Matthew Bromberg, took over last year.
So a leadership change was key.
Absolutely critical. It needed a required and frankly painful strategic correction. Bromberg and the new team couldn't just tinker around the edges, they had to act decisively immediately.
What did that involve? Just cutting things?
That was part of it. They shut down or sold off entire business units that were underperforming, lagging on sales, and just dragging down the company's overall earnings and focus. That kind of restructuring is tough, but necessary to stop the bleeding and get rid of distractions.
Makes sense. But just cutting stuff doesn't usually spark a turnaround that doubles the stock price.
Yeah.
What was the growth part of the strategy?
Right, good question. Restructuring clears the deck, but you need a new engine. And what's driving the improvement now is their renewed focus on high-growth tech within their core areas. They didn't just cut, they launched a whole new digital marketing platform.
And what's special about that?
It's heavily focused on leveraging artificial intelligence, AI tools, AI features.
Ah, AI, of
Yes.
course.
Exactly. They basically took their core strength, which is their massive amount of data from the gaming ecosystem and their position in digital creation, and applied the hottest, most powerful technology available right now, AI. They built a new platform designed to be indispensable for digital marketers in this new era.
Okay, so they're betting big on AI to fix the marketing side.
Yeah.
Is it working? Are there results yet?
Yes, and that's the exciting part. We're seeing tangible results almost immediately. The market is clearly rewarding it. Thanks largely to this new AI-powered marketing platform, Unity's advertising network posted a 15% sequential sales increase in the second quarter.
Okay, hold on. 15% sequential. Why is sequential quarter-over-quarter growth so important here?
Because in a turnaround story, especially one based on a new product launch like this, sequential growth is what you want to see. A jump year over year could just be easier comparisons or broad market trends. But a 15% increase from Q1 to Q2, that tells you the new CEO's strategy, the AI platform, is actively gaining traction right now. It validates the pivot. It shows the shift from just cost cutting to actual AI-driven growth is working and working fast.
Got it. So the key takeaway for Unity seems to be a recovery driven by fixing internal mistakes. They own their flaws, brought in new leadership, did the hard restructuring, and then successfully executed a major strategic pivot using AI to boost sales in their core advertising business. It's kind of a messy turnaround, but maybe a compelling one because it was an internal correction.
Absolutely. So if we put these two stories side by side, you, the listener, are looking at two really different paths out of a deep stock price hole.
Yeah.
You got Carnival successfully navigating the aftermath of this huge, external, unpredictable shock, the pandemic. Their actual business, demand, operations look great, but that balance sheet is heavy, making them sensitive to macro things like interest rates.
Right. External shock, macro-dependent recovery path.
Whereas Unity's problems were almost entirely self-inflicted. Poor strategy, execution failures. Their turnaround was a painful internal pivot, fixing those mistakes. It relies much more on execution risk going forward.
Meaning, can the new management team keep making the right moves? Can they keep leveraging AI, rebuild that trust, and drive sustainable growth? It's about their skill, really.
Exactly. Internal correction, execution-dependent recovery path.
But the opportunity in both cases, the reason we're talking about them, is because their performance seems detached from that broad market surge we mentioned at the start.
Precisely. They aren't just riding the S&P 500 wave up. They seem to be recovering based on their own specific company strengths and actions, which makes them interesting, deep value, or maybe turnaround plays.
They're deep discounts that have clearly started moving the right way, but yeah, with fundamentally different kinds of risks attached. We've seen a recovery from a massive external blow, like Carnival, and a recovery from an internal collapse and strategic shift, like Unity. So for you, the listener, if you're looking for value in these beaten-down areas, it really raises a crucial question you need to think about.
Yeah, what kind of risk are you comfortable with?
Exactly. Should your priority be a company fixing problems caused by a big one-off external event, like Carnival managing its pandemic debt? A risk that maybe just gets easier if interest rates fall?
Or,
Or should it be a company that's proven it can execute a major internal strategic turnaround, like Unity leaning into AI, where the risk feels more tied to the long-term skill and focus of that new management team? Which model feels safer or offers more upside? What kind of long-term risk are you more comfortable owning?